S&P 500 closed under the 200-day moving average for the first time since January. The Nasdaq managed to close right above it. Semiconductors were unfazed by the carnage today, not even making a lower low, as financials were pummeled based upon news of illiquidity at one large regional bank. That closed down 60% today. The single largest move the VIX has had in about a year. The real question is, will this banking crisis actually cause a crash of the market itself? Will the larger, more diversified banks actually hold in here? Several important technical indicators that are actually hitting new lows for the first time this year. What stocks can benefit greatly from this sell-off? Is coin next? And why the move in SIVB is eerily similar to what happened in 1980 with the savings and loan scandal. So what exactly happened today? Well, we came in and we're preparing for data. When we're preparing, we have a jobless claims number that comes out, and that comes in right around that 200,000 range, a little higher than expected. And it was really a non-event, and it's been a non-event. We went over that today in the pre-market live stream. But what was interesting was we rallied, and we rallied pretty significantly. And you can see that throughout the day. You can see the 830 bar right from that jobless claims number, and then the rally up, and then retesting that really critical level of 420 that we're all aware of, or 4020. You can see a little level here and how they walked you down. And then it started just leaking more and more. Now, one of the key issues today was the $2.5 billion that was in here that had to be out there on the street for recapitalization. One of the core issues today, when SIVB gapped down over $91 from the open and previous day's close, was that they had to raise $2.5 billion. Now, while that wasn't the larger issue, there was a much more glooming issue out there that they really weren't being clear on. And they revised their outlook for 2023. And when they revised that outlook, what they did was they started alluding more and more facts as the day went on. We started gleaming more and more. So here was our open, and then we see the upper channel here. When we were in the room today, we pointed this out, and we're just talking about this on the live stream, like, hey, we're breaking right here. This could continue to drop. Now, at the time of this, all I had is the same exact data that everyone else had. My thought was we'd come back down here and retest that level. But as the day wore on, what wound up happening is just more and more carnage. And I thought you might hold that level and find some dip buyers, but it became increasingly clear that there are more issues here that they were not discussing. To start with, we walked into being down $91 on a write-off and the fact that they had to raise close to $2 billion in a common stock offering and $500 million in bonds. Now, as the day wore on, you can see how the open, we were unable to break, and you can see our trend line right here. Now, these are fairly easy trades when you get up here. They're really just retests of key levels. Unable to close above that open was a key sign. Breaking this trend line was a key sign. We actually talked about this in the trading community today and was saying if you were interested in shorting, this was the spot, that it looked like a perfect short, and frankly, it was. But the issue with this was I was not thinking that we were going to continue to plummet because the information that we had was nowhere near as significant as the day went on. And that started to become increasingly clear. At this point, we knew that they had a decline, right? We knew that they needed capital and that the 2023 outlook was murky. As the day continued, we learned more and more. Now, what we started to learn was not only do they need to raise money, but every liquid asset that they have, they sold. So all their liquid assets, they sold. That's a huge red flag to anybody in the banking industry. And then we start trying to understand what exactly happened. And this is when we have this huge drop because we start understanding that this is exactly what happened in 1980. And we're going to go through that. You come back, you retest, you try to hold on, but there's no holding on here. Now, the reason that you're down even another 20 points after hours and why this might continue to drop and why this could lead tomorrow to some issues, and I think you're going to bounce all around in here, guys. Opening up 20 or down another 20 or 30, I think we're going to be all over the map. And this is definitely one you're going to want to watch tomorrow. I'm just going to give you a huge warning here from my experience and looking at the implied volatility today. The implied volatility of these options is absolutely insane, and I would significantly suggest, unless you're extremely savvy, just avoid them. I mean, we had options out there today, the 125 puts, the stock went from 130 to 100 and they didn't move. So the implied volatility is just through the roof as people sort through this. Now, the issue that you're running into is the reason they lost money was deposits. Not because they lost money in crypto, not because of anything great. They lost money in deposits. How did they do that? How did they lose money in deposits? Well, first we need to explain exactly how banks make money. And in order to do that, we're going to just have to understand one graph, okay? And this is the 10-year Treasury minus the 2-year Treasury. And this is what they refer to as the yield curve. Anybody can see this. This is at stlouisfed.org. And essentially what we're looking at here is from 76 to 2023. Now, we have been raising rates at a level that is unprecedented and never seen in history before. And this is what's happening. Since we started, we have dropped from, we are at 1.44% to down to negative 1.07%. Now, to make the math simple, let's just call this a 2.5% differential. 149, you get to the zero line and you add another 1% to it, right? So we get 2.5%. And that took how long? About 18 months for that to happen. That's how long banks had to adjust to this happening. Now, for context, we've only been this low once before, and that is over here in 1980. And the importance of that is if you look at the differential, let's take the top of this, which is 1.5, very similar to where we were over here in 2021. And you look at that date and realize that's 1976. You come down and you go, okay, well, we got to 83 cents. Well, that's not a full 2.5 point move. What would that 2.5 point move look like? Well, we have to get to that 1%. So then we get here to that 1% level right down here. And that's going to put you right around the end of October 1979 that you have that differential. So it took 3 years here. It took half the time here to get to the same rate. This means that banks had more flexibility in longer period of times to adjust than they did here. Now, obviously, technology and things make it a lot faster, but nonetheless, if you have deposits or outstanding loan obligations, it is what it is. This is the 10-year Treasury. You're at 3.92, meaning you're at 3.92% on a 10-year Treasury. At the same time, we can see the yield imploding here on the 2-year Treasury, going from 5.07% to 4.88. Now, this is happening for a couple different reasons, but the spread between the two still exists. It's just no longer at 100 basis points. It's actually getting a little tighter. And by a little tighter, I mean a little tighter. But you can see this here that we have broken that 100 basis point inverted yield curve between these two, but we're still significantly higher here by almost 100 basis points. So now we know how this is calculated. Now we know the rate of which this has moved over this period in time versus 1976 to 1980. And we know how this is calculated. Now, Capital Advisors Group does a really good job here of just explaining why this is a problem for banks. When short-term rates exceed long-term rates, they create an inverted yield curve, which is often taken as a signal that investors are more optimistic about short-term prospects versus the long-term, suggesting a lack of confidence in continued economic growth. An inverted yield curve is often seen as an early warning sign of a coming recession. The effects of a flattening yield curve on bank credit quality, a narrowing spread on the yield curve, and the possibility of an inversion also banks profitability. A narrowing spread on the yield curve. A narrowing spread on the yield curve and the possibility of an inversion also impacts banks' profitability. As banks pay short-term rates on deposits and take long-term rates on loans, the steeper the yield curve tends to positively impact the bank's profitability levels. A flat or inverted yield curve, therefore, could lead to negative net interest margins. The Dallas Fed analyzed how interest rates affect profitability levels of banks of different sizes and found that banks with lower average earning assets, this is the important part, less than 1 billion, reported higher profitability levels stemming from interest rate sensitive activity. Now, this is explained very clearly on this graph. So this is all U.S. banks and then how this is going to change based upon all U.S. banks. This is with banks over 15 billion, and you can see how the average is here in that slope, and then you can see how that slope gets here faster. In other words, the average slope, you're getting to about a 7. Here on the larger the bank, you're getting to about a 4. This is going to be really important because of what we're going to go over later and what stocks you should be looking at buying. Now, assets with banks with an average of 1 to 15. You can see the basis points and the drop to 2.5 basis points down here. If you have under $1 billion, you can see your level right here. Rule of thumb right now, after what happened today, we probably don't want to go near banks that have under $15 billion in assets. So essentially what is happening here is their deposits are being withdrawn. People are withdrawing their deposits because they're not getting paid enough, and they're having to pay on loans that are much longer term. Until this changes, which is when the inverted yield curve would get, quote, tighter. Until that changes, this company and this bank is going to have issues, period. This is a systemic problem for this bank and the way that they have positioned themselves. This is not a quick, quote, trading loss. This is not a loss on just some bonds. This is people basically just putting their deposits somewhere else and then them not having the cash flow to keep the game going. That's why they came out today and made this announcement. They're looking at 1.25 in common and 500 million depository shares, okay? Now, what's concerning about this and the convertible is that it puts you really in a position here where you almost have what we refer to as a death spiral. What they do is to get people to buy the bonds. They announced today that they intend to offer 1.2 billion in common stock and 500 million in depository shares, consisting of 10 million preferred stock, liquidation preference, 1,000 a share, equivalent to preference of $50 per depository share. Listen to the words, mandatory convertible preferred stock, meaning it's convertible. So in other words, not only do they have to convert these shares, this 500 million, they have to convert this while they're paying a yield. So you have a company that can't meet its current obligations, yet it's taking on more debt. What firms are going to do, now that they understand the risk, is they are going to short SIVB, okay? And they are going to short SIVB against their convertible. They're going to get the debt payment, and then they're going to book the spread between when they're going to execute that convertible and then where the stock price is, and they're going to make up that differential. Okay, it's a home run, but what it does is it puts huge pressure on the stock. Now, this pricing is probably going to go pretty fast, and it's probably why, even as we're talking, we're watching the stock down to $84 right now. Now, how do we profit from this? Well, one of the things that I always do is I want to look at analysts, but I look for whoever the axe is. Now, Mike Mayo is a guy who's been around for a very long period of time. And when he speaks about banks, there's really nobody that's more important, in my opinion, or actually understands banks better than Mike Mayo. Now, if you look at what Mike Mayo is saying, the drama, particularly at SIVB, rattled bank stocks. The SIVB moment is not fully indicative of the industry, but does affect sentiment. We all saw that today with the way that we sold down. And you can see that the big banks sold down as well. Mayo points out that larger banks with more diversified funding are better positioned to weather the recession. That's exactly what we showed in the previous graph. We favor larger banks would have a more diverse funding without the same type of extra funding from corporate deposits and or hot money of selected banks. That's what SIVB had, hot money of selected players. So now that you understand why SIVB is losing money, why they're being hit so hard, what the inverted yield curve is doing to those smaller banks, it's going to be the same game all over again where the big is going to win. It's the same exact game again. Same as 1980. And we're going to cover that very briefly in a moment here. So names like JP Morgan, if this gets worse, absolutely this could come in. But today, and I took a position in this already, if I don't break that low, and we'll find out tomorrow morning, right? Everyone's worried about the payroll numbers. It's funny how it works. While they're important, the chances of the Fed going out there at 50 basis points in the middle of a banking crisis are pretty much slim and none, quite frankly. And if they do, he's going to have a real issue, pal, in my opinion. But that's just an opinion. Now, you see this level right here? If I don't break that, where's my risk? So in other words, I'm sitting right on this support line, right in here. Okay, and I actually bought stock and I bought options, but I'm looking long-term here and I'm willing to take this risk. But I'm sitting right on this level. I'm down 13, 14 points. Obviously, this leaked at some point. We see the financials getting a little weaker in here. But what do we do now? Well, this is where you start trying to build if you're looking long-term. I don't know if this holds. And if it doesn't hold, I get out of the way. But on a $130 stock, it's costing me $1 to find out, plus the gap risk of what I have to deal with tomorrow, which is why instead of just all stock, I would also take a look at options if you're comfortable with it. Goldman Sachs. We didn't even make a lower low. I couldn't even get to the support level today. I couldn't even make a lower low with a major regional bank blowing up. Okay, so to me, are we going lower? Looks like it could be a failed H to me. I don't know how they're going to bail out SIVB if it's possible. It's very different than SI and what's happening there. The surprise for me with SIVB, and I would focus on Goldman, and I would focus on JP Morgan. If you just want to play the space, there's two ways to play the space. Number one, you take a look at FAS. FAS is the financial bull 3X. Okay, that's what you want to look at tomorrow if you want to be long. If you think I have no idea what I'm talking about with these larger names and you want to bet against me, you would look at FAZ, right? And you would go out there and you would do this 3X bear fund. Let's say that you think this is going to be massive systemic risk. Maybe you're right. Maybe there's more risk than we know about. Wouldn't be the first time, right? These are the levels that you're going to want to watch tomorrow, okay? So my opinion is that this is a great opportunity to start dipping our toe and seeing if these banks are going to hold. And we're seeing signs that the market's flushed out. And I'm going to point to those in a moment. But before that, I just want to walk through something. This is what happened to the savings and loan in 1979 in October. And this was all based upon that rate move that took 3 years that we went through previously. See how it's all connected tonight. Starting in October 79, the Federal Reserve of the U.S. raised the discount rate that charged members from 9.5% to 12%. Okay, at that time, S&L had long-term loans issued at fixed interest rates. Sound familiar? That were lower than the newly mandated interest rate at which they could borrow. Okay, so in other words, they're locked in on their fixed long-term, but now they can't borrow at the same rate. So they went from 9.5 to 12. When interest rates at which they could borrow increased, the S&L could not attract capital. So in other words, they couldn't get capital. They couldn't get more deposits to keep the game going. And I'm calling it a game because you just have to have the money flow. If you don't have the money flowing in, you don't have your inflows, all you have is outflows. Attempts to attract more deposits by offering higher interest rates led to liabilities that could not be covered by the lower interest rates at which they had loaned money. The end result was about 1/3 of S&Ls became insolvent. Now, the more troubling thing for me is the fact that they were not out there stress testing these banks, that they're not out there checking what's going on and how deposits are being affected and the health of these smaller regional banks while they're raising rates at unprecedented level. That lack of preparedness is somewhat scary to me. And that might mean there might be more of these out there. Now, I would imagine if you start seeing these crack, and this one in particular, which is having massive issues again this evening, now we're down to 83. If we're seeing these kinds of names crack, well, that's just going to lead to a much larger group of issues. We saw the VIX spike on the news pretty substantially. We haven't had a move on the VIX like that since about back here, which would about a year ago. And we haven't really seen a move like that. And that's something that we're going to want to pay attention to. But really the way that I'm leaning is I'm leaning towards JP Morgan, Goldman. There's going to be one bank left here standing, guys, in my opinion. And everyone knows how negative I was on coin, and it could be the next time bomb, and I could be wrong, but Brian Armstrong's out there just pounding the table, doing the rounds, and that's not what you do right now if you're trying to hunker down and stay out of the limelight. So he's staying in there, and we'll see how this happens. I am absolutely shocked that these levels are holding in here. Absolutely shocked that we're holding these levels, that we did not break with the rest of the sector. SI blew up, SIVB is blowing up, SBNY is another one that looks extremely weak, and they're all blowing up for different reasons, but the issue is all of these banks, they're all crypto related. JP Morgan walked away from Gemini, right? All this is going on. Forget about FTX. That's so 30 days ago. But you look at what's going on right now, and then you look at coin going, that's it. That's all you're going to do. You're not going to drop $10, $15. Now tomorrow is a completely different day, and we're going to have to watch this level very, very closely. But to me, it just looks like we're breaking out, forming a GTL, and possibly setting up to re-challenge these levels. Very interesting that that's the action that we're getting right now. Now, I'm going to cover this in greater detail this weekend and what names to look for, and we'll get more in depth, but there's some real highlights I want to go over so that you're prepared for tomorrow and what to look for. First and foremost, how bad is this? Well, this is the S&P and stocks above the 200-day moving average. Today's the first day we cracked the 50 line since we broke above it January 6th. We're all aware of what happened January 6th. It led to a huge run in the market. We're cracking that level. This is irrefutable. Okay, this is not great. I don't want to be below 50%. You go look at performance, I want to be in that 50%, or I want to trough. I don't really feel like going through another trough level again. The market might not care what I want, but I really don't feel like dealing with that again. That said, where we're at now and how this is rolling, if we stayed in this level, I was fine with it. We are cracking, so we have to be aware of that. But at the same breath, when we look at the S&P and we look at S&P stocks above the 5-day, you're at a 4. That means 96% of all stocks are below their 5-day moving average, which is absolutely insane. And these arrows mark those locations when it's happened. Now, if you look at that and we overlay this with the orange that's in the S&P and we correlate it to where we're at right now, very simply, all we do is just take that out for a moment and look at the S&P. And these are where you had those readings in the past. So while long-term I'm not crazy about what I'm seeing, this could be setting up for some kind of bounce. So it wouldn't surprise me if we do bounce here, even if it's very short-term. Usually when we get this low on stocks above the 5-day moving average, where you're at a 4, the level's so oversold in the short term that there's usually some kind of bounce out there. The magnitude of the bounce, I really don't have any idea. And I would also just tell you to focus on what names hung in there today. Well, if we look at what names are hanging in there as the S&P's dropping, you have Dix that hit an all-time high today, did not take out a lower low. It's kind of impressive. Even First Solar, I'm just going to throw a couple out there real quick for you to watch tomorrow, get rid of these drawings. We're still forming a flag. Where's the panic sell? And why would they wait till tomorrow for non-farm payrolls if they were going to sell, right? So when you start thinking about it like that, start connecting the dots a little bit, I don't really have a strong answer for you. When I look at NVIDIA, let me clean these off and I can get into that later. And yeah, I have a bearish engulfing up here. I'm not crazy about that particular pattern, but you know what I didn't do? I didn't gap fill. I came to levels not seen for 3 days. Like, it's not a big deal what happened today with this particular sector. And I think that's what's so puzzling to me. You know, why aren't we just falling off a cliff? Why aren't we just completely imploding here on semiconductors? People will say, well, it's going to happen. Is it? Because if it was going to happen, a regional bank that's tied to technology blowing up seems like a really good time for tech to go down. Instead, all we did is not even make a lower low. We didn't even make a lower low. All we did was get to this DTL and reject. That's all we did today. So that's something for us to think about. We'd be remiss to not cover Tesla. You know, for me, I thought we'd at least try to get back up to that 185, 186, and we did for a little period in time. And then as that news came out, it just got worse and worse. And obviously Tesla's being hit pretty hard by that. We tried to get through 180, reject and retest. Please comment on this video. I know I went through a lot today and I went through a lot of content that I could spend a lot more time on, and I can really dive into this concept. If you are struggling right now, I'm going to strongly suggest that you watch this video that I made that's 10 minutes long. I've gotten a lot of really good feedback and comments on what the next video is going to be released. So make sure you subscribe to the channel because we're going to release another one this weekend. Also, you're going to want to make sure that you do get the newsletter. But if you're struggling right now, the link for the newsletter is in the description. Watch this video, it will help you greatly. And tomorrow, non-farm payrolls do matter, yes. Do they matter as much as large regional banks blowing up? No, they do not. Have a good night, everybody. Trade to win tomorrow.